We're going to briefly touch base on the program that we offer, which is called the Great Coaching and Mentoring, pretty much offered to the business directors and entrepreneurs. The main factor is the KPI scorecard that we publish. From your data, from your information, from your operating system or your accounting software, we'll be able to get a lot of valuable information. What we do with that information is what is really profound, has significant impact on how profitable and how well you can manage your business. First one being customer service. The KPIs like DIFOT, which is delivered in full on time. That simply measures from the time that you receive an order and you promise the customer that you're going to deliver a certain thing or a service in a week's time. Some of them, they have next day delivery. How can we track and monitor that performance and report on those traction, keep your staff engaged, publicize to the customer is aware that the moment they walk in with you into your shop, into your premises, or they deal with you, they know that you are going to deliver the promise that you make to them. The other factor is error and wastage and credits. If you're issuing 100 invoices in a month and you end up crediting 2 products back, that shows either the pricing is wrong or the product is not right or there is some quality issues. So it's often good to track these kind of factors and report accordingly so you can enhance your business systems and streamline your process at the back end to make sure that we reduce the error and wastage and we maximize on delivery performance to ensure customer is satisfied. The third one is customer satisfaction. The customer satisfaction survey is drafted in conjunction with the business owners. We understand the products that's offered, what segment that we are analyzing, and we do the data collection on your behalf, and we can submit your statistical report and coach and mentor your staff so that they are aware of market movement and position your business to succeed. The next KPI scorecard is based on occupational health and safety aspects and examples like LTIFR and MTIFR. LTIFR is lost time injury frequency rating, and there is a formula that's published on our website as to how you calculate that. MTIFR is medically treated injury frequency rating. If a staff, as a result of a workplace incident, misses a shift, that affects your LTI. If that leads to a medical treatment under certain classification, it will be treated as an MTI. Now, to me, these factors are lag indicators. It's great to deal with a company that has a very low LTIFR and MTIFR rating. Fantastic. However, what is the business doing to engage their staff and their team members to positively take control of their work culture and safety performance? Hence, the PPI score is very critical. Businesses often plan their safety audits. There are some mandatory safety audits that you need to conduct and report against them. Engage your staff and your team to organize a safety meeting or a toolbox meeting or a safety committee and keep communication process through so staff are empowered from the time they start with you. They clearly have an understanding of what is expected. They get the induction, they get the ongoing training, and we audit, conduct workplace observations, monitor the systems, and report based on how the systems are performing. That gives you a clear understanding of what systems you have, how good do people observe and comply to them, and most importantly, what sort of a culture do you actually create? It's well and good having great policies and publicizing that you've got a great statistical record. However, if it was just window dressing with no back-end integration, the system's going to fall apart. The next one is finance KPIs. Some of the things that we have come across, important things for small business, are things like DSO, that's daily sales outstanding. On this particular example, we have marked it as 32 days. If you are selling to your customers and they range from cash sale through to accounts, you can monitor how quick the money has been collected by your accounts receivable. The next factor is the financial KPIs. And the first example is daily sales outstanding, in short, DSO. On this particular example, we found it was 32 days. So customer comes to you, buys something, and you put them on account. Approximately, it takes them 30 days to collect the money. Clearly, the average being 32, some are cash sales where you get the money up front, and some customers pay you probably on 45 days. And average 32 days worth of sales is outstanding at any point in time. It is very imperative that the business and the directors understand that that's the cash flow that you are putting out in the market, which is your money, your working capital. Hence, DSO is a very important factor when it comes to understanding and managing your business and your cash flow. Next factor would be cost of sales to revenue under 20% in this particular example. Every business is different, whether you're in the service industry or whether you're in management type services or you're selling a product. You've got to understand what sort of margin that's available. Your cost of sales to revenue in this case was 20%. Now again, there is no one size fits all. We will undertake extensive benchmarking from the industry perspective, and we'll be able to talk to you and engage you more. There's no one size fits all model. We will do the necessary research to engage you and the market, and we'll be able to provide you with a clear strategic vision as to where the cost of sales to revenue ratio in your business is. The final one would be ROFE, R-O-F-E, returns on funds employed. We have touched base on that before. There's EBITDA, which is earnings before income tax, depreciation and amortization. Those are those factors that are financially driven factors. The third factor is ROFE, which is return on funds employed. All it simply means is what sort of a return are you getting for the amount of capital that you have invested in your business. It could be accounts receivable that you're still waiting to collect money from your customers. It could be stock that you hold and other investments that you've made in your business. And as a return, you want to know how much of returns are you getting out of that business. If it's about 20%, it's a good number. However, if your ROFE is anywhere between 5 and 10, you'll be asking questions, was your money worth invested in your business or somewhere else? The fourth KPI factor is operational excellence. As you've seen in the past many slides and serials that we've produced, that available to promise to a customer is very, very critical. So your ATP rate, which is indirectly linked to your delivery performance, has to got to be a robust number. Anything above 95 is best practice. Wastage and controlling scrap under 1% is a fantastic number, and that shows that the business has gone a long way to control and manage their wastage in the business. The third one is operational excellence or overall equipment effectiveness. The third factor is OEE, which is overall equipment effectiveness. If you are in an industry where you are processing on machinery or your finished product relies on 3 or 4 different unique processes, you want to make sure that each of those manufacturing units or the business units are performing effectively. It's like tool time, your upskilling, and your time that you waste, your machine utilization are all factored into this equation to ensure that your operating machinery are operating effectively. The final one, the fifth one would be a supply chain scorecard, and a supply chain KPI classifies your products into A class, B class category, and your slow moving stock. Again, that's a simple classification that we would come up with in conjunction with the business owner. A class would be a product that moves every month, every week. B class could be a product that moves every 3 to 6 months. And slow moving stock could be anything that's 6 months and over. So that sort of a knowledge is going to be powerful. You can then make decision to stock your A, B class stock and have a strategic plan for your slow moving stock. While it could be critical for a customer, you would, if you can forecast, you would then know when to order those products, how long to hang on to your shelf, on the shelf, to make sure that you are maximizing on your return on funds employed. So at some level, all these KPIs are interlinked. If a customer is going to be satisfied with your available to promise and you do deliver on your performance, on your promise, you measure it with your ATP and your DIFOT. And that tells you how fantastic your systems are integrated from front end to back end. Automatically, you will see sales improving, your margins will pick up, and if you're able to strategically operate with a streamlined business process, less wastage, better customer service, clearly has to result in better profits. Thank you.